Welcome to the Bitcoin Infinity Show, brought to you by Bitbox, Stampseed, the Bitcoin Advisor, and ShopInBit. Go to bitcoininfinity.com for books, merch, and more. Enjoy the conversation.
Adam, welcome back to the Bitcoin Infinity Show, newly rebranded.
It's a good name. Good to be here again.
Yeah. The correct greeting would be, good morning, Adam. Welcome, Adam, back to the Bitcoin Infinity Show. Right. So how are you today?
Yeah, pretty good. Good to be back in Riga at this conference. It's one of the few kind of Bitcoin-only conferences that's still running. They did a panel yesterday talking about the history of Bitcoin, of the conference, and they observed that there were some people that had come to all of them. Apparently, I was one of them. I didn't realize, but that's true though, in the sense that I like Bitcoin-only conferences. So, there's too many conferences really for people who have a day job to go to, or maybe even for anybody to go to at this point. There's so many conferences, right? But if you've got to make a choice, you want to come to the Bitcoin-only ones, and this is one of the good ones.
Yeah, I missed the first one, but I've been to all the other ones. So this is where everything started for me, and I really like it because it's so high signal, low noise.
Yeah.
And I don't think there's a single shitcoiner in here this year.
I met a couple of people who aren't fully orange pilled, but yeah, there aren't any crypto vendors or anything.
No one's shilling this
nice
stuff.
Yeah. They've got a good thing going.
So how has your year been? Last time we interviewed you was here in Riga last year. So
it was.
What has happened? So you made a price prediction then, I think.
Yeah, I was seeing let me see what time of year. Yeah, it's probably at this time of year. So I think the price was like a bit depressed, like maybe in the 30K range or something. And I was saying we might see 100K before the halving. And everybody thought I was insane because they thought we were going to see 10K or something. Dismal was the next outcome. And so, of course, if you make a price prediction and you miss, you always get ragged, but it's not a precise science, right? And so my argument is, well, I was directionally right, that we had a new all-time high before the halving, which had never happened before. And it wasn't 100, but it was over 70, which nobody saw coming. So, and there's a lot of stuff going on in the world. So I'd take that as a kind of philosophical win, personally.
Yeah. The all-time high was when we were on Madeira, I believe.
Yeah.
That's when it happened. So
cool.
That was a big moment. Direct, stupid price. We never talk about price, but when does Bitcoin hit 100,000?
Well, probably maybe even this year or next year. I think there are a lot of there were a lot of temporary headwinds which are wearing off. The bankruptcies selling, like FTX bankruptcy selling, because some of these bankruptcies take a dollar-denominated definition. So they declare a bankruptcy date and they sell everything to dollars, and then they run their process, try and claw back what they can, and then pay it out. And so people get back. The people who had the Bitcoins on there would sooner have the Bitcoin and experience the Bitcoin price movement between the bankruptcy date and today, even if it's like a fraction of the Bitcoin. But no, what they did is they sold to dollars and they declare that everybody made a profit, but now they have to buy the Bitcoin back at 4 times the price or something.
Yeah.
So, there's a lot of things like that, different bankruptcies, selling, government seizures, Mt. Gox paying out. Mt. Gox doesn't seem to be having that much effect, but people are presumably just holding it. But, there's a new game in town, which is the ETF buyers. And they are, I think, predominantly in the US. These US ETFs, of course, you can buy them internationally, but presumably mostly US buyers. And if you look at a segment of the US kind of individual investors, so if you take the top 10% of wealth, you subtract the top 1%, the billionaires kind of thing. The top 1%, top 10% might be, professionals, doctors, lawyers, business owners, people with a portfolio ranging from a few 100,000 to a few million kind of thing. And between them, they have $30 trillion worth of stocks and bonds and different things in their portfolio, basically. And so we think it's those guys that are buying. And if you look at the ETF inflows, 30 trillion, 1% of, if they did a 1% allocation, it'd be 300 billion, which would move the Bitcoin price, because even though Bitcoin's market cap's like maybe 1.3 trillion, the price is set at the margin and there's a multiplier of money in, as we know, right? So, and so if you look at their allocation so far, if you assume it's all US, they're like at 6 basis points or something. So they've got a way to go. And, not all of the wealth management firms have internal approvals or training materials or, rules about how they can sell it in place yet. So I think that's got some room to go. Another thing that was going on is post-halving, miners are having a bad time. The hash price is down, mining profitability is not so good. There's still a surplus of miners. And so you've got people with sunk cost miners. So they're going to turn them online, even if they are just to reduce their loss, right? And so that kind of suppresses the hash price. And so some of them have been selling Bitcoin. I mean, they try to accumulate and keep Bitcoin on a balance sheet, but some of them have been selling their Bitcoin, to get through this tough period, right? So once that runs out and you've seen some consolidation, like acquisitions and mergers and bankruptcies in the mining sector, so once their selling stops, that helps as well, right? So it's all about like the balance of sellers and buyers. So yeah, I think, and the other kind of positive surprise is the ETF buyers seem to be good hodlers. Like they buy and they don't sell. Like, there's a decent pullback and there's very little outflow from the ETFs. And, they're even inflowing, buying the dip a bit at times. So, and of course that affects the money multiplier, because, if somebody buys and they're new to Bitcoin and the price drops 10% and they sell, they're not really helping, because, they push the price up and they push it down and they offset. Or maybe they make it worse, right? Because Bitcoin tends to have, with stocks, there are analysts who are looking at prices that work for pension funds and things like that. And they will have a price target. And if the price gets low, they'll say it's cheap and they'll put money in and they'll buy it because they've got a thesis. With Bitcoin, most of the people who have a thesis have no fiat left. And so absorbing downside is difficult structurally, right? So people who buy and panic actually might go net negative. So, but the ETF buyers apparently are not like that. So that's positive news for the price, for the structure, market structure. So, yeah, I think there's a lot of good setup here. And, people are talking about institutional interest, but I don't think there's that hasn't landed yet, really. There's a few very early funds. So institutional, we would mean, right, pension funds, mutual funds, like managed by professionals on behalf of individuals rather than individuals making allocations within their own portfolio. And so there are a few places where, BlackRock has added it to some managed fund or Fidelity, but there's very few of them and they've made small allocations. So I think, there's lots of, all of that is ahead of us. And that's even more money than this, the top, 10% minus 1% band of investors in the US. That's a much bigger pot of money.
Yeah. You mentioned miner profitability there, and the one thing we've explored on this show a lot is the spam issue. So I'd love to pick your brain on what your stance on that is, and how big of a problem it is, how we solve the problem, what the fee spikes are doing to, custodial lightning providers and stuff. Like, what are your thoughts?
Yeah, I mean, of course, because Bitcoin is permissionless, there's nothing we can do about it. And we need that to be the case because, censorship is, if censorship is possible, it can be directed at anything, at spam and things that, some group of people don't like. And so there's not much we can do about it in terms of selective filtering, just inherently, right? Because Bitcoin is permissionless and censorship resistant. But in terms, and some people will say just a kind of free market statement that spam doesn't exist. If people pay, it's not spam because they paid for it. But I disagree. I think it's clear that Bitcoin is, focused on use cases and outcome for savings, ability to transact the savings, ability to do transactions to use it, to support second layers for more kind of permissionless payments, and activities that degrade the ability to transact, that hurts, hurts layer 2. Maybe, they're also consuming UTXO space and it's a scarce resource. So they're going to price some newcomers out of it. Like the wealth levels in the world are quite disparate. And so, they may price some newcomers out of being able to even own a UTXO, which is not a positive thing. And, the spam transactions are not, as a value judgment, I think they're useless and stupid, right? They're just putting JPEGs on the chain that, obliterate the space of 100 UTXOs at a pop. And so, maybe they think they derive value from it in their kind of NFT Ponzi game, but it's negative for Bitcoin.
Yeah. So what about an initiative like Ocean, for instance, that just chooses to, or lets the individual miner select the block and?
Well, I think it's good. It's good for individual miners to be able to select blocks or select block policies, because you want it's kind of decentralization theory that you get a more robust system. Especially, that's basically how censorship resistance works in Bitcoin, which is if one miner won't process your transactions because he doesn't like you, another one will, because there's a fee involved, or because philosophically he doesn't want to see any policy there, right? And so from that point of view, it's good. Now, they do get some ribbing because their blocks may be less profitable. And so, some people will philosophically, they'll mine the block with the highest fees, even if it's full of JPEGs or something, right?
Yeah, but I think the rationale there, as far as I understand it, is that the bigger mining pools mining these blocks with all the spam in them, that they might be getting payments under the table, so to speak. So it's not transparent. So the individual hash salesman that sells their hashing power to that particular pool might not get as big a cut of the reward as they think they do. And that in the long run, you might be even more profitable mining with something like Ocean.
There was I think Bob Burnett looked at this and did this over quite some time, and his Ocean pointed ASICs did better than various FPPS pools. He didn't name the pools, but yeah. So apparently,
yeah. It's clear that when they're doing this, the fees go up. I saw a fee spike just a few days ago, right? But it's very positive if the rational thing to do, that's positive for Bitcoin actual native use cases, also is more profitable, because it shows the free market potentially has a solution. And also, just because we are economic actors doesn't mean we have to be hyper rational. There are some ethical, some people won't accept stolen goods out of principle, right? A lot of people, and we say, but it's cheap. You save money, you make money by doing it, but they don't want to do it because they disagree philosophically. And so there is potentially some scope within Bitcoin mining for kind of soft policy type of things, right? Which is, they choose to deprioritize JPEGs or something, right? It's possible that what that's saying as well is that the pools taking under the table payments are being unethical, actually, right? So that they are under-reporting or keeping the profit or excluding the profit from their payout calculations or something. So, yeah.
Yeah, maybe it's not that they're being unethical, but that the hash salesmen aren't vigilant enough in checking what is actually going on. So they just accept, I'm making a profit, so therefore I'm good, when they could have been making a bigger profit with a more ethical behavior. The spam, like the long-term risk of the spam is that the cost of firing up a new node gets so high, so it's somewhat of an attack surface. in the long run will reduce the number of individual nodes because they're too expensive to run and hurt decentralization. So what's your take there?
Well, I mean, I think, the miners are typically, not the pools, but the miners themselves are typically Bitcoin holders. They want to mine a Bitcoin at a discount and keep as many of it as they can because they're trying to build a Bitcoin stash or treasury for the company or, stacking sats for the owner or operator. And some of these pools have been around a long time, so they're like privately owned and stuff like that, right? And some of the miners too. So if that's the case, they're not just kind of short-term profiteers. They have a long-term alignment in Bitcoin's adoption curve, usefulness. And, if you take it to the extreme case, which sometimes helps to reason about things, if everybody went crazy and shrunk the blocks effectively or made it very disruptive, so it hurt use cases, made Lightning harder to use, then, that could impact people's confidence in Bitcoin and being able to transact with Bitcoin, or it could push everybody to custodial wallets or something. So it could have a long-term negative effect on the Bitcoin economic, price and adoption curve. And so from that point of view, as a long-term investor in Bitcoin, as a miner, let's say, maybe you're willing to forgo some, fee spikes because you think that that will help Bitcoin and you help everybody eventually. Now, the problem is the freeloader, right? So, if everybody takes that view or enough people take that view, it works out. But if it's, only 10% of people do it, then the people who take the more freeloader kind of mentality, they actually profit short term. So,
yeah. So the question boils down to, is that incentive strong enough, the incentive to keep Bitcoin alive for a long time, or is that a weak chain in the link of Bitcoin security?
Well, I mean, I think, because one other sort of risk that people talk about or like to talk about, which I think is premature, is the prospect that the reward eventually stops because the halvings or becomes less significant, right? And then they wonder, does the network have enough incentive to secure itself? And my argument is, there are lots, most other forms of money are weaker, so fiat depends on, 10,000 banks, none of them being hacked, kind of weakest link in the chain, and audit, discovery of insider theft or unauthorized printing and stuff like that. So I think people need money to work. And so, with Bitcoin, there's a $1 trillion incentive for it to work from all the savers, right? And so I think they would actually find ways to make it work regardless, right? Even if it meant, spending 1% to do a bit of mining that doesn't make a profit because they value Bitcoin, or, they have a business that makes money because of Bitcoin. And if it becomes less functional, that has their business. So there are other, kind of mutual cooperation situations. I mean, a close one is internet peering arrangements, right? So the internet, retail who's using an internet connection is paying a service provider, but at a certain level of service provider or telecom provider, they have peering arrangements where they agree to transit each other's traffic in a tit for tat, or without payment, or with some calculated rebalancing or something. So it shows that, those companies need the internet to work. And so they'll find a way to cooperate, even if it's not, hyper rational behavior, because ultimately they make all their money from the internet working well. And so you could see that working with Bitcoin. If Bitcoin's the internet of money, why couldn't that work with Bitcoin? So I think it could ultimately. So I'm not really worried about, I think long-term things will work out. And I think the other point is, these use cases might just price themselves out. The fee spikes haven't lasted that long so far. And also they tend to, rug pull the investors. And I think the investors are getting fatigued. like, get sick of losing money, and then they eventually learn. So, I saw a post in the last month by some altcoin guy, but it was basically a plea to altcoin creators and meme coin creators to reduce the pre-mine because it was making hard to sell new coins, because there was almost no possibility, even for a lucky retail investor, to make any money, because the insiders were just, dumping on it before it had a chance to succeed, and the users just gave up, lost interest in playing the roulette game, right? So, from that point of view, this kind of profiteering is sort of killing itself slowly as well.
I guess the devil's advocate argument to that is that what if a spammer has an actual money printer, and this is it's conspiracy theory waters, but if this is actually a state-funded attack to reduce the usability of Bitcoin and thereby saving the legacy system, it's far-fetched, I know, but is that scenario even possible?
I mean, I guess they would be paying. So, I mean, potentially the Bitcoin ecosystem would have more money to fight back because the attacker is paying it. So, maybe something creative could be done. I mean, I think there are if it became a problem, there would be workarounds, right?
Great news, everyone! Bitcoin, the Inverse of Clown World, is out now.
It's the successor to Everything Divided by 21 Million, and it's based on the last 2 years of podcasts that we've done together. So if you like the show, you're going to love the book.
Find the book on bitcoininfinitystore.com or on Amazon.
That's right. We have our own store now, bitcoininfinitystore.com. You can find not just books, but merchandise based on Everything Divided by 21 Million, the Inverse of Clown World. That's bitcoininfinitystore.com.
So check out Bitcoin, the Inverse of Clown World today, and buy some other stuff while you're there too.
This show is brought to you by Bitbox, our favorite hardware wallet. It's Swiss engineered and has all the most important security features to keep your Bitcoin safe, while keeping a user experience that even your grandma can use. So visit bitbox.swiss/freedom to learn more, or use code FREEDOM at checkout for 5% off. And remember, it's the Bitbox 02 Bitcoin Only edition. Make sure to get that Bitcoin Only firmware.
Bitbox.
All right. Next topic.
Well, a follow-on on this one is the effect on the layer twos, and I mean, Liquid, I think, saw quite a bit of adoption, right, as a result of these fee things, like the other incentives that people moved to other layers, basically, and people with Lightning channels were very happy, but other people without Lightning channels were less happy, and things like Bolt's interoperability with Liquid and things like that seems to have solved that. So I mean, What has been the effect on Liquid in all this?
Yeah, I mean, I think we were talking about this last time. So it was it had just started to happen then, and it's actually continued and grown. And so there are more wallets using Liquid and Bolt's combo. So it's a way to have a Lightning wallet without having a Lightning wallet, kind of, right? So you have a Liquid wallet and use the Bolt's exchange to swap Liquid for Lightning, or swap Lightning for Liquid. And so to the user, it feels like they are able to interoperate with Lightning. It feels like they have a Lightning wallet, but actually they're using the managed channels that are using Bolt's own capital on the main chain, and they're atomically swapping Liquid. So I mean, the original mechanism they built was to rebalance Lightning channels. And it started on the main chain. It got disrupted by the first wave of ordinals and inscriptors. And so they rapidly implemented a Liquid Bitcoin submarine atomic swap to rebalance the main chain. But over a period of months, that became used by wallets as an API. Originally it was just for people managing channels to rebalance channels, but it became actually second use, which is a wallet API. And so that has continued to grow in popularity. So it's sort of competing with other Lightning stacks. Say Blockstream, for example, has Core Lightning, which is, there are a few, like 3 or 4 Lightning kind of node and library implementations, and Core Lightning is one of them that focuses on interoperability and standards, evolving the standards, doing things in a standard interoperable way. And then we have Greenlight, which is a kind of lightweight way to integrate Lightning into wallets. It puts more of the kind of support intelligence on a server, but the key signing and verification is done on the device. So it makes it more lightweight because you don't have to download as much stuff. And so effectively, Blockstream has two products indirectly. Now, of course, because these are infrastructure products, other people are building things around them and innovating, right? But effectively, Blockstream has part in two things which ended up competing with each other. There's Greenlight as a way to make a Lightning wallet, and Liquid plus Bolt's tonic swaps, which is now, both of those things are growing, but they're competing with each other, right? Because they're alternatives. You either run a Greenlight integrated Lightning wallet, or you do a full node Lightning wallet, or some other system, right? Or you don't do a Lightning wallet and you get one anyway by using Bolt's API and swaps. So it's pretty cool. And since we talked last year, there've been Bull Bitcoin has stepped up and really gone for this model. Peach Bitcoin is doing it. I just hope somebody at this conference is also doing it. And Breeze is actually using Greenlight. But yeah, so it seems to be growing as a convenient way. And I think the other thing that is, the next bottleneck you could foresee coming is that, okay, you can use other layer twos, and you could also use eCash, right? Like the cache and a Fedi, the glue that holds those together, and they can have multiple mints, right? Is Lightning. So you can also implicitly rebalance a Lightning channel using, Fedi Cash or Cashew Cash, right? So the ability to rebalance existing main chain Lightning channels with other layer twos, like you said, that helps if you already have a channel. But what if you don't have a channel? Now you've got to establish a channel. And if the fees are really high, maybe that becomes impractical. So now you can clearly see that Bolt maybe helps because you don't actually have the Lightning channel. They do, right? And so they can survive in higher fee environments because they got fat channels, because they're shared amongst lots of users, right? But for users that actually want the self-custodial channel, just to be clear, that you are self-custodial with Bolts. It's just that your custody is on Liquid, right? So it's kind of neat because you get the sort of reliability and performance advantages of a custodial channel-like arrangement, except they're not yours. They're Bolts' and it doesn't affect your self-custody, right? Whereas a wallet, I think Blue Wallet was an example of this, and Wallet Satoshi is the biggest one, right? Where it's actually custodial. You just own a share of a big channel, and that's it. It's an IOU, right? So Bolts doesn't have that problem. So the obvious problem is, nevertheless, what's going to happen next? And so what we're doing with Greenlight is there is Lightning on Liquid. So, because Liquid is organized in the same way as Bitcoin as a blockchain, Lightning works on it, and a core Lightning implementation has worked on Liquid for, 5 years or something, right? But there has never been enough demand or reason to, grow a network and liquidity and interconnectivity there. But the time may be rising for that. And so the idea there is that using Greenlight, we can kind of merge the networks. So there are a kind of merger of the two networks, so you can route through both types of channels. And that's good because it means that you get interoperability. So somebody has a main chain channel, they don't really need to know or care that the sender has a Liquid Lightning channel, or if they also have a Bitcoin Lightning channel, but some of the intermediate hops are Liquid Lightning channels, because it all interoperates and it's anyway atomic. So right, you don't really care if the characteristics of the channels are slightly different in the middle. And so that opens a new prospect, which is once that's in play, it's in development now, some wallets might, the different types of users in the network, right? We've seen that the service providers, the API providers, and the stores, they can afford fat channels. So actually they're okay, they can survive, right? But the retail endpoints, that gets expensive. If you want to like set up a Lightning wallet and receive $5 of liquidity, which by the way, somebody is probably, lending you and trying to recoup by charging you fees later. So that liquidity is expensive. If it costs $5 of fees to put $5 on there, that starts to get problematic, right? And so, there is the world where retail users end up using Liquid on Lightning, and for the endpoints that are direct self-custody, not using bolts, and they're cheaper. And the obvious thing to say about Liquid is blockchains aren't scalable. Liquid's a blockchain, and if you pushed it too far, gigablocks like some forks we won't mention, then it will also stop being a blockchain for many purposes. But I think the middle ground is that because it's anyway not as decentralized, you can assume a kind of more power user profile. Like you need a reasonable, home internet connection with 10, 20 megabits or something higher, right? And you need a faster computer, like maybe a reasonable laptop class computer, not a Raspberry Pi or something. And then it can keep up. But if you try it with a Raspberry Pi and we have to scale it in this kind of middle range, at the moment it runs on a Raspberry Pi, but if it needs to get scaled, then that won't be the case. So I think there's a sort of incremental scale you can get to, but beyond a certain point, it stops making sense. So I think that means that there is scope for Lightning on Liquid to fill in a bit. But like the other observation is that, the market is still evolving things. Like the Bolts API is like a pure market innovation, and almost a happenstance, right? The people who built it weren't anticipating it. So there were like three parties involved. Like we built Liquid, they built Atomic Swap, and then wallet users started using their channel rebalancing to build a new architecture standard, right? So, who knows what the future holds, right? There may be new things that evolve. Of course, the eCash protocols are very scalable, but they have a different trade-off. So the limitation there is, firstly, the model is quite similar to Liquid, like it's a federation. It's just that the federation is, a community situation, where Liquid is a federation of Bitcoin exchanges and wallets and different companies, right? So you got that factor, but then laid on top of that, you also have the trade-offs of the eCash protocols. And so they have extremely good privacy. They're unauditable because it's a side effect of the privacy. You can't audit how many coins have been issued. And so you don't know, you can audit the coins that are pegged into it, but you can't audit if they issued a matching number of coins. And so you have the prospect that, with any kind of peg, there's a risk that the peg gets bypassed somehow and the peg coins get taken out, and then you're fractional, and then that's game over, right? But with the eCash protocols, you've got the possibility of it going fractional in an undetectable way and staying that way for years, like a kind of slow theft, right? If there's people generally paying in and not paying, if you can see that there are 100 Bitcoin in and 100 Bitcoin out, but people are still using it, I think they have Bitcoin, then clearly it's fractional pay, but you won't find out until that's the case. But now, so in between, you could think there's 100 Bitcoin in there, but actually they issue 200, and you don't have a way to detect that, right? So that's the trade-off. Now, there's a positive side effect of that, which is because you can't audit it, there's no audit stream. There's no like big amounts of data of past transactions to download in blocks. And so it becomes very scalable, right? So you don't have to sync a node. You just like connect to an eCash server. It's very little data. So that's the trade-off there. So I think the other variable is, other than custody, we don't know how much people will favor the Fedi and Cashew approach. If that gets a lot of adoption, that's a form of scalability with a different trade-off. So we'd have to wait to see what the market likes,
Yeah, I think it was Lynn Alden that made the point that yes, because even with custodial Lightning and stuff like this, you can do fractional reserve banking on Bitcoin effectively, but to a much smaller degree than in the legacy system. because you have something to measure against. You can see it's not like there are cameras in Fort Knox that we can see all the gold there and how much is actually there and stuff. But you can still see on-chain transactions. So that it's possible, but not to the massive, not on the scale that the legacy system has.
Well, yeah. I mean, I hope that, I think Lynn is talking about kind of competitive free banking. So the concept that you could have a fractional reserve Bitcoin bank. Now, I hope that never happens and that people refuse to use any such proposals, right? But I mean, and maybe some free banking people would think that's okay, that you can have fractional Bitcoin banks and people can choose them based on how well managed they are or how long they lasted or whether people trust them. But I would say never accept fractional Bitcoin. And so I hope that the market takes that outlook, that does not use fractional Bitcoin. But I think the challenge is that, particularly with some of these community run things, you don't necessarily know who's running them, or even that, if it's like a 3 or 5, that's not all the same person. Kind of silly tell, right? So sooner or later, somebody is going to try and rug pull them. And you don't actually know, how many coins they printed, right? Because you literally, basically what happens is what's supposed to happen is you peg in coins into the mints and it issues you with coins. But because of the privacy, they can issue, the owners of it can issue, if they collude as a federation, can issue themselves more coins and you can't audit it. You can't detect that, and then they can spend them. If they overdo it, eventually it might become apparent because, people might withdraw and then it hits 0, and yet there are lots of people who think they still have a balance, right? Then you'd notice. So that kind of trade-off. And of course, it's it has IOU risk as well, right? Because it's if the operators are regulatorily attacked, they might be forced to freeze it or something, right? So, and it's a very interesting trade-off as well between, identified company-operated federations and community federations. So I think, people tend to trust themselves. So they feel good about community because they could participate, they could run their own, and they trust themselves and their friends trust them. But on the other hand, it might be more of a gray area about whether that's regulatorily okay. Now, I assume that, because families de facto do, some shared financing and things, that in a small scale, there's probably nothing that could be said about it. And it differs in countries, right? Some countries have very little banking, and so everything is organized like this, right? So maybe that's, the target use case. But at least with the exchange companies, you the pool of companies that may be running the hardware, the nodes, and they are anyway operating regulated businesses typically, right? They're operating an exchange where they do KYC and they have banking, they have bank accounts. And so it's maybe not introducing them to, they're already regulated, right? So, maybe it doesn't change their profile that much. So that's a kind of interesting trade-off. So, my viewpoint is generally, just build things and react to what works in the market. And because it's you can't centrally plan or plan ahead because it's too complicated to map out, like some of these old coins do. There's a dictator who thinks he's benevolent, who's drawing roadmaps and waving his arms and saying this is how it's going to work. And I think in the real world that never works. So people are just going to build things, and if you want to succeed in that environment, you have to adapt to what gets innovated, what gets traction, and what the market wants to use. Users are could be more pragmatic than the operator of an individual company who thinks, things really should work this way and they like this and not that. If the users make a pragmatic choice, they won't use that product, right? So I think that's, that's one of the reasons you have to adapt.
Some people already make the choice not to use specifically Wallet of Satoshi, and choose just a different custodial provider because it seems like the risk is lower in others. The wallet of Satoshi seems to be like the big one, that if that one were to collapse, it would be a big deal, basically.
Yeah, I mean, it's interesting in some areas you see people gravitate towards the biggest because they think it's the best. But in this case, the biggest is the highest risk because it's relevant and, they have more users. So one of the users will do something incredibly stupid or illegal and create the external investigation. So it's probably the most at risk. Probably a balance though, right? If it's super unknown, maybe it's just set there to like rug pull some unsuspecting users. So I guess, there is some kind of owner reputation, like if the owner is publicly known and also if they've been involved in the space for a long time, probably helps. Like they've a Lindy effect, right? That they've been operating for a while. It's no guarantee. Like you can get late rug pulls.
Yeah, if I got the point right from Lynn's book about free banking, there's like that there's nothing inherently wrong with fractional reserve banking as long as it's transparent and the users or the customers of the bank know that is what they're doing. So the banker can tell their clients that, okay, are you okay with us using a portion of your wealth to invest in other things? And if you are, we will be able to give you an interest in the long, and to give an interest over time. And she argues that like the problems come in when you have a central bank and banks get bailed out and you have all these government guarantees and stuff, because then that whole system becomes way, way, way much more complex, and it's very hard. At least if you have a bank a fractional reserve bank, and it goes bankrupt, it's the users of that bank that pay the bill in the end.
It's true that it avoids the moral hazard and kind of perverse side effects of central banking, like implicit guarantees and so on. And it's also true that the right people suffer the consequences, which is if you thought this was a good idea and there's a bank run, it's you that lose, right? But at the same time, like there were a lot of bank runs. So historically, right, before they introduced central banking, now I don't like central banking, but I also don't want to experience a bank run when Bitcoin repeats the pre-central banking fractional reserve situation. So I want full reserve banking. In fact, I want either single custody or a multi-sig so they can't spend it so they can't make fractional without my approval or something, right? And I mean, there's a gray area of fractionality, which is kind of rehypothecation, which is to say, you put your Bitcoin into a bank, they make a business loan of the Bitcoin to somebody, and they have collateral for the business loan. So if the business fails, they can sell the business assets and rebuy the Bitcoin and pay you back. So, a small amount of rehypothecation sort of sounds okay. And I think a lot of that happened in the DeFi though. And the problem is that people get greedy and the competing people offering interest, they have a race to the bottom, right? They offer higher and higher interest and they take more and more crazy risks till they're ultimately lending to people who are running Ponzi's or hedge funds making directional bets that backfire. Because to their point of view, they take the upside and if it fails, they shrug, right? Now it's not, if a wealthy investor chooses to take that risk profile as a hedge fund investor, fair game. But if somebody who is let's say Gemini Earn user who just thinks, they're offering interest and assumes that it's inside, they don't think about how does that work, right? That it creates problems and you get contagion and so on. So I think the non-fractional reserve is the way to go, or at least fully collateralized, like over collateralized lending. And the problem is, people know, but the prevailing interest rates on Bitcoin and dollars in the Bitcoin trading and exchange ecosystem are very different. So the dollar interest rates are double digit, 10, 15, 20%, depending on the market conditions. It's mostly used for leverage, right? But also for business working capital, like miners will borrow dollars to buy more miners or something against Bitcoin or against miners. So the prevailing interest rate is high because there's a shortage of dollars, because too many people, I mean, of course, I think it's a good thing, but like everybody's very all in, so they don't have any dollars. So there's a shortage of dollars, and the big pools of institutional capital and bank capital outside of Bitcoin doesn't understand the risk. And so they're scared, right? So they, they'll be earning, 5%. It could earn 15, but they're scared of the risk profile. They think it's not worth it, right? So, and then on the Bitcoin side, there are very few people who are short Bitcoin for long periods of time. And so it's very cheap to borrow Bitcoin to short it on exchanges. There's lots of people leave their custody of Bitcoin on exchanges, many traders. There's lots of Bitcoin sitting there. So they got like a free market rate. There's a huge amount of Bitcoin and very few people that want to borrow it. Of course, the borrowing rate is like, fraction of a percent. It's not worth lending. It's not worth intentionally exposing yourself to the custody risk to get the interest rate. That's a bad deal, right? So consequently, when people offer you, mid-single digit interest rates on Bitcoin, like 5%, that implies necessarily, for the most part, that they're making unsecured, uncollateralized loans of Bitcoin to other people. And then if that person is, how are they creating that interest rate? Well, they're gambling on something, right? And if they get it wrong, then the person rehypothecating it is going to lose money, and then you're going to lose the coins. And that's basically what happened in the DeFi implosion.
And especially if you have a huge bull run in the midst of it, then they'll never be able to buy back the coins.
Yeah. I mean, it's also, it's all about directional bets. So lots of examples, some users, because the problem is the risk profile is getting laundered through intermediary borrowers and lenders, right? So you'll put it in something that is trying to be conservative, and they'll give it to some other party that's providing an interest rate, and hand waving about how they they do due diligence, they only lend to reputable borrowers, blah blah blah, right? And all that they stand in the way, like they will repair a loss. But then what really happens is they lend to somebody else who lends to somebody else who's doing something crazy, right? And then, even if these guys say that they'll stand in the way, they're just doing that to make a sale. And when too many things go wrong, they go bankrupt, right? So the guarantee is also not worth anything.
It's The Big Short. It's basically the plot synopsis of The Big Short.
Yeah, I love that film. And it's very ironic that, the Bitcoin ecosystem is like repeating the exact same problems. Yeah.
Did you see the GameStop one? I don't remember the name of the film, but it was very similar to The Big Short.
I haven't seen it.
You haven't seen it?
I'll go look. Yeah.
Yeah, you should, because it's very like there's so it's about the GameStop's stock, and there's a ton of Bitcoin memes in it that originates from Bitcoin, like HODL, for instance, and we're not selling and all of this stuff. And the thing is, when you see that movie, it's like all of these people that were involved in this did this when Bitcoin was already a thing. So like it's not that far back. So if they had done the exact same thing with Bitcoin, then the big hedge funds and stuff and Robinhood couldn't have like suppressed it at any point. So it gives you like, holy shit, when some guy like that gets the same idea and gets the same momentum on social media and stuff on Bitcoin, then it's like game over. It's every single saver starts just, I'm not selling.
Yeah, I mean, the GameStop is interesting because it exposes a few things. I mean, one is that the people with different power have different access to the market. So the retail traders are trading through Robinhood in this case. And Robinhood, for technical reasons, might have to suspend trading just when you need to trade.
Yeah.
And that's
technical reasons.
Well, I mean, the technical reason is that the delayed settlement, like the T+1 stuff. And of course, like the technical reasons could be politically biased, right? Is to save their big friends, right? So it's like any kind of brokerage like that is going for a prime broker in a clearinghouse as a stack rank. And because it's delayed settlement, it's really naked selling, right? So you're selling and buying on your platform. If there's an imbalance, like your users are more buying than selling. Now, you haven't actually paid for it yet. And so they're worried you're going to be able to if the price moves. And so, they have to have a certain amount of working capital with the prime brokerage to guarantee their trades. But if they get like a massive, crazy run of buying, they run out of capital and their prime broker cuts them off because they're like, well, we're not going to absorb that risk. You either send us like tens of millions of more capital or we're going to suspend trading on this stock. And they couldn't do it that quickly, right? And so for the users, it was horrendous because, they got stuck holding a bubble. And the fact that the trading stopped probably caused the bubble to collapse as well. And they got to sit there and watch it fall where they can't react, right? So that's that kind of dysfunctional. I mean, the Bitcoin market never does that, because it's global, 24/7. It's real time. There's no delayed settlement. Nobody's naked selling anything. You don't have these problems, but it shows like the structural problem. And then, the other thing, which is, the thing is a dog, right? It deserves to be shorted, and the hedge funds are shorting it for good reason because it's a defunct business, right? And, but, if you short, it's dangerous to short things. And so, these crowd of social media guys on Reddit decided to, play a game of chicken with the hedge funds and like basically bankrupt a few hedge funds along the way and cause the short squeeze. So as well as the hitting the limits of the market function due to the way it works and exposing the biases, right? Because the hedge funds will be desperately calling in favors with the prime broker and they're big. So maybe the prime broker wants to keep them happy and doesn't mind screwing over the retail users on GameStop, right? On Robinhood. So it's a pretty ugly situation. Yeah. So, in Bitcoin terms, you have different games. I guess like Terra Luna was an example, right? That there you had basically what was pretty clearly a Ponzi to anybody who bothered to look at it. And I didn't care about it, but the reason I looked at it was because they were buying a lot of Bitcoin, I think like $100 million or something. And people were getting excited. Like, Bitcoin, some Bitcoiners were saying, well, look, this is great. There's a new buyer in town. They're buying lots of Bitcoin. And my view was, well, wait a minute. Like, what are they doing with it? Are they going to is that Ponzi going to collapse and they're going to market sell 100 million Bitcoin in an automated, they have these automated market makers, so kind of trading bots that become dysfunctional if there's a huge reaction in the market. And, they could cause a stupid flash crash or something, right? At least in their local market. So my thought was, I don't think this is a good thing. I think it's some Ponzi that's going to collapse. So I went and looked at it and I was like, yeah, that looks like a Ponzi to me. And, within a few months, it died spectacularly, right?
Yeah, it was glorious.
Yeah. And actually, it didn't look like they actually had finished automating the Bitcoin selling part of it. So I think some of that got sold through, some kind of market maker that did it carefully. And I think they stole some of it, like the insiders. So it didn't actually all get sold in one go. But if you just do a market, a dumb market, if you just hit market sell on something like that, you can wipe out the order book basically, right? So you don't, but I think it also shows that making a trading bot, the smart contract guys in altcoins think they're a bit naive about market function. So they will, if there's a smart contract and it's magical, right? So they got a smart contract and it's going to sell if this happens. And it's like, either it's centralized, say like a decentralized smart contract that has an API to a centralized exchange that's, where the account is owned by a business entity, it's not decentralized, or it's decentralized. And the decentralized things are using these automated market makers, which they have some liquidity and they have like some kind of mathematical curve where it will react to an imbalance of trade and put the price up. But the problem with those is that they only work within a narrow band, and if things get extreme, like there's a massive rush of selling or buying, people can pull their liquidity out and the curve can get steep and it can just get silly, stop functioning. So that was what I thought was going to happen to that Bitcoin. But it turned out, they stole it, and they hadn't done the development work to add it to the automated market. But the thing that was automated suffered the most radical hyperinflation in history, right? Like billions of percent in a few days or something.
Knut, what are you doing over there?
I'm stamping my seed. Everyone tells me I should. That it's good for Bitcoin security and whatnot, and that I should go balls deep into Bitcoin security. So I'm stamping.
No, you don't do it like that, Knut. You don't stamp that seed. You stamp your seed phrase.
What?
Your seed phrase.
Oh, so that's what these things are for. All of this stuff that they sent me. Like, I get it now.
That's exactly right, Knut. And you can get everything you need to stamp your seed phrase at stampseed.com. And be sure to check out our limited edition Everything Divided by 21 Million titanium seed plate. And use code Infinity at checkout for 15% off.
That's fantastic. And it hurts way less.
This show is brought to you by the Bitcoin Advisor, your premier destination for professional Bitcoin management.
Yeah, so if you want help with your Bitcoin inheritance planning or anything like that, you can call us or send us a DM because we're Bitcoin advisors.
Exactly. They've been serving Bitcoin clients since 2016, and they offer a top-notch Bitcoin concierge service, including collaborative custody and estate planning. We're on the Bitcoin Advisor team ourselves because we believe 100% in what they're doing, and we're happy to tell you more about the Bitcoin Advisor on a call.
So check out the bitcoinadvisor.com or just simply shoot us a DM for some Bitcoin advice. Hey, dear listener, don't forget to like, subscribe, and brush your teeth.
And if you're enjoying the show, the best way you can help us out is spreading the word on your favorite social media platform. Ours is Nostr. The show is going Nostr first, posting the episodes on Nostr 1 day early. And if you'd like to support the show, the easiest way to do that is to send us a zap on Nostr, use a value for value podcasting app to send us a boost, or pick something up from the Bitcoin Infinity store. We appreciate the support.
Yeah, go click like, go click subscribe, and go brush your teeth now.
The crazy things that can happen on Bitcoin in kind of this still early phase where kind of things are still finding the equilibrium as more capital flows in. And I mean, the other thing that we've been at this week has been the Nostr Riga. And this is another thing that's very early days in its decentralized communication. And then just overnight, this is day 2 of Baltic Honeybadger, the news comes out that the CEO of Telegram has been arrested for, I don't know, the charges are, I guess they're in the news, but
refusing to censor people.
Basically seems to be that. So what are your thoughts about that whole situation? And maybe there's some solutions in the development pipeline. What do you think?
Well, I mean, we have this book in front of us with the Clown World logo, and that's pretty much the situation. I mean, the charges are like ludicrous on their face. And, there are lots of communication channels in the world. And I think you described it as censorship, but I think what they were saying is like he hadn't put moderation in effect. Well,
same thing.
I mean, yeah, exactly. And I mean, actually, some people are like pro-moderation, anti-censorship because they draw a distinction. But I hate moderation too because, I used to, there are a few sort of mailing lists related to Bitcoin that some of them are still around. One of them was Cypherpunk's list, and one of them is the cryptography list. And the cryptography list was operated by an individual who's still there. And, he's moderating. So, like, for example, there was a long discussion about Bitcoin, like in 2009, where people say, oh, that won't scale, and like, blah, blah, blah. Like, there's like, a long discussion. And he cut it off like, oh, that's enough talking about Bitcoin. I think it's kind of silly. And, if you write a paper about it, maybe I will allow the conversation to continue. And that just enrages me, right? Because like, if I want to talk about something, I don't want anybody citing it's boring, or they've had enough of the discussion, or they don't like the topic, or they don't like how you're saying it. Like, fuck that, excuse the French. But so like moderation enrages me, basically. I hate it. So yeah, I mean, the idea that the government should, demand moderation. I mean, actually, isn't there some kind of, what do you call that? Like with the internet, where you're a common carrier, so you're not responsible for the content. And so at least in some countries, if you do moderate the content, you lose your common carrier status, and you really don't want to do that, because then you become responsible for what people are doing and saying on your platform. Like if you fail at moderation, like the fact that they are trying to insist that he moderate it would actually like lose his common carrier status, and you don't want to do that, right? So now I guess like architecturally, the problem is that he could implement a moderation policy. And I think there are people who get their Telegram accounts banned. I've heard people complaining about that. So, they're kind of probably in a bit of a gray area where they're kind of, reactively censoring things. But, that exposes the difference between, decentralized chat platform and a centralized one. And Twitter was like horrendous for, I think people still get banned on Twitter unreasonably, but, at least Elon cares about free speech and does a lot less of it, and fired a lot of people who were doing political, there's like moderation or some kind of policy, but then there's like political interference, moderation abuse, which unfortunately Twitter and a number of companies were doing in a very extreme way, like interfering with election discussions and all kinds of stuff, right? So, yeah, I think the Nostr protocol is, that's showing that actually we need more of that kind of thing. So, yeah, I don't know, what's going on behind the scenes with Pavel Durov at Telegram. Maybe there's something they're trying to squeeze in for, like access to some data or something. I have no idea. Or maybe they just like don't like free speech. Somebody was saying that there is something political going on in one of the French jurisdictions, like offshore jurisdictions, where there's some political upheaval and people are coordinating their protests with Telegram. So it could be related to that, timing wise. Who knows? But it's like clown world ridiculous that a government, or it's effectively a group of governments, right? Because it's in Europe. If it'd been another European country, they would have done the same thing. That they're just losing the pretense of independence of law and the rule of law, but they're just going to arbitrarily, see somebody off the street, like in a third world tin pot dictatorship. It's like insane. Yeah.
Fortunately, they're just increasing the what's the word? The pace of the process, because like these things have been going on for a long time. Like when I remember the Pirate Bay founders in Sweden were prosecuted on very loose grounds because they had a website that provided links. There were no actual files on the site, and Google was pointing to their website. So why are they guilty and Google not? And so it's all gray area, and it's like, where do you draw the line between moderation and censorship and political censorship? It's so clear to me that the people in power, the so-called elites, the most successful thieves, are abusing this on such a grand scale. And the way out of it is not through another private company, it's through things like Nostr and Bitcoin that we truly take the power back. There's no other way. And it's just, we need to spread the message about it and get it out there and get people to adopt these things, because that is the only way to fight it.
Yeah, it's true. Like it's, in a way, it's positive that there are people who are fighting within the system, like Elon, who will, go to court or buy the company.
Yeah, and his price tag is higher. If anyone wants to censor him, they have to pay very much a higher price.
But, he may not be immune, because, he's doing the right thing, standing up for free speech, but they do have levers to attack him, and he has some vulnerabilities. Yeah. Like, for example, the subsidies that a Tesla company is receiving, maybe the military launch contracts that SpaceX has, or just trumped up, political charges like Durov, right? So, could that apply to Twitter? Like maybe.
It could be called, if it does, it could be called the $5 trillion wrench attack.
Yeah, basically. So, it's now I think we should care about the rule of law. Like if there are rules, they should be impartially exercised by an independent judiciary. And the fact that is going downhill is like a bad thing. So in a sense, us retreating into decentralized technology is, a defense mechanism for, civilized society to continue while governments are devolving. But it'd sure be a nice thing if governments weren't devolving. And but I think those things interplay as well, because if things are decentralized, while the establishment powers that are pulling the strings behind things like the Durov arrest, they want some control outcome, right? They resent that people can talk privately and coordinate on channels and things like that. That if they could see that arresting somebody would have no effect, they're probably not going to do it. So, if it's Nostr and there are some people who are like lead developers, but there's no central server, there's no company operating a server, you could like seize one coordinator or, arrest that guy or shut down that company or sue this person. But it's going to be pointless, and it might even have a Streisand effect that, there were 10 servers, now there are 100 in more jurisdictions or something. So to that point of view, it forces a bit of internet physics on these people that want to abuse establishment power, which is like, pi is 3.14. You can't say it's 3 because the internet doesn't care kind of thing. So I think it's it's decentralized things that erode the internet physics, and that like things should be implemented in robust, decentralized ways.
Yeah, and the same logic that applies to Nostr sort of applies to a plethora of other things, like Fedi, for instance. Things are going to be much harder to take down in the future, and that's very promising.
Yeah, I think if you think about it from that point of view, what we were discussing, the trade-offs between Fedi and Liquid, but one advantage Fedi has is that, it has a higher rug pull risk of a federation because you don't know who they are, and they could be all one person. But there are multiple of them. So if and Fedi, the company, is not operating them. Now, Blockstream, the company, is not operating Liquid, but, the federation members, potentially, if there was like some kind of major global crackdown on Bitcoin or something, could be told to stop, right? Now, with Fedi, they could stop some, but like people have all the tools and could start other ones, right? Now, it's also true with Liquid, like there's most of the technology is open source that, you could stand up another Liquid network. And a few like very technical people have done that for experimentation purposes. And we're interested to take steps to make that easier, like to sell the hardware. Because part of the formula as well that we didn't talk about is that with a federation, it's a blockchain. The interpretation that people have taken from independent legal advice and so on, from regulatory expert independent advice, and from ask for opinions from through government regulators, is that this kind of collection of software and hardware and decentralization, it qualifies as a blockchain. That's the argument, and that's the opinions that people have had, right? But if you compare that with Bitcoin, now nothing is as good as Bitcoin, and if anybody generally invents some technology that would improve the picture, Bitcoin would generally want to adopt it. So it's cool, like any kind of layer 2 is generally going to be inferior to Bitcoin in multiple ways, right? Including their Lightning and Liquid and Fedi and all these things, right? They're making trade-offs, because if there was a silver bullet, Bitcoin would already do it. So the point is, like with Lightning, you get faster transactions, but it's all a hot wallet. So, there's a trade-off, right? You get something, you lose something, and that's sort of inherent, I think. But, what we're interested to do is to sell the HSMs so that people can, and they're programmable, tamper-resistant devices. And so they do help the blockchain argument, right? Which is the architecture of Bitcoin that makes it neutral or censorship resistant, is that there are competing miners than people that will mine things, right? So if one doesn't mine it because they don't like your op return, or they don't like something about, some taint tracing, another one will mine it. And what helps with that with Liquid, that's possibly true, right? one block signer could sign and the other ones would, and it only takes 2/3 of them to process it, right? So that's one factor. Another factor is it has confidential transactions, so it's harder for them to tell what the transactions are about. So like, if somebody has a policy view that they want to like block this type of transaction or something, maybe they lack the information to make their policy decision because they enhance confidentiality. So that's another factor. But the third factor is that you have an HSM in place of so it's a block signer instead of the miners, comparing two architectures. And the block signer is a piece of hardware. And so it's a black box. You can't like reach in there and change its behavior because you'll reset the keys. And it's only running signed software. So Blockstream doesn't have any kind of auto update for obvious reasons. So the operators of the hardware, they have the source code, they can look at the changes, they can see there's nothing malicious about it. They have to upgrade it. But once they've upgraded it, they can't, open the box up and like change the software in it because they'll reset it. And so, it's not a piece of software in a decentralized system. It's a slightly less decentralized system, but with a piece of hardware. And so, it gets to a similar location via different technologies, confidential transactions and hardware tamper resistance. So I think the hardware tamper resistance is a useful tool. And as you may be aware, one of the very early sort of Bitcoin-like systems, RPAL by Hal Finney, reusable proof of work, is actually using this tamper-resistant hardware. I mean, the much earlier first versions of it, trustworthy computing stuff. So he bought an IBM manufactured tamper-resistant hardware device. And his system was you would mine using Hashcash, you would send it to his server, and it would send you an eCash token. And so that would prevent the rug pull inflation because him as the owner and operator of the server couldn't change the software. And the reason is that the hardware gives you a kind of, they call it a remote attestation, but basically the hardware signs and provides to the users a signature of what code it's running. And he can't influence that, right? I mean, he can load new code, but then changes the signature. So people can see, oh, that new code is malicious, I'm going to stop using it or something, right? So I think that trustworthy computing or tamper-resistant HSMs are an interesting building block for a lot of things, like for Cache, for Fedi, for Lightning routing nodes, because they're hot wallets. So if you can provide better security for Lightning routing nodes, it becomes safer to have big channels because, if somebody compromises a hot wallet Lightning routing node, they could steal the channel balance, let's say, right? So, as they become more accessible, like if we resell them, then that helps. I mean, because we're just like, it's a programmable device, you can do what you want with it, right? So you can use it to build like an Arc thing or a cache thing, whatever you want, basically, or to make to make an HSM for cold storage or something, right? So that's like another sort of blockchain adjacent building block, which can be used to harden some blockchain related things.
Sounds like a exciting new thing. Looking forward to seeing that coming out. Anything else you're excited about in the coming year?
So I mean, we've been working on a Bitcoin ASIC. So really the idea was that a couple of things. So at the time we started, so we acquired Spondulis, which is a company that's been making ASICs, Bitcoin ASICs since 2013, I think, or maybe even 2012. So they made multiple generations of Bitcoin ASICs, and the team is came from ASIC design company, so they had some prior experience. And I think the Bitcoin ASIC is a challenging type of ASIC design because of the duty cycle and the hand optimization that's needed and so on. So just say we have a team with a track record, and we made an ASIC, we've done a shuttle run, which is a kind of a test run. So we have sample chips that we're testing and continue to optimize. So the motivation really at the time was that all of the mining manufacturers were in China, and not that the foundries weren't, because none of the advanced node foundries are in China. They have foundries, but they're like a generation or two behind. So, but still there aren't many foundries. So, and that seems potentially like a centralization risk. And China is like intermittently hostile to Bitcoin, like banning Bitcoin, banning mining, and things like that. So, it's not inconceivable they could apply pressure to those companies to stop making Bitcoin miners or impose something, right? So we thought it was, potentially risk, and we'd like to try and like reduce that risk for, because we're interested in Bitcoin. So we embarked on that. I think, the situation has improved a bit. There are a few more companies internationally making Bitcoin ASICs now. Some talking about them publicly, for example, Block. Intel was for a while, but they exited the business. I think they were having like general like economic problems in the company. So they cut back some divisions. So they exited the business. But there are a few other companies that have been making ASICs, like, so we're hoping that we'll have some more announcements about that in the next year. And I think another motivation for having an ASIC is that none of the Bitcoin mining companies would sell anybody ASICs. So people who have made Bitcoin devices like block eruptors and space heaters and water heaters and things like that, which are kind of cool, they can't buy the ASICs. They have to buy the miners and desolder the ASICs off them. And of course you break some doing it, and it's kind of inefficient, right? So, I think we were more interested to, allow people to buy ASICs, like have some more like open innovation where people can build, different profile miners or consumer miners or appliances with ASICs in for various reasons.
Yeah. I think it's time to wrap this up soon. So anywhere else you want to direct our listeners other than to Blockstream? No, I think it's an interesting time for Bitcoin at the moment. We've also been, getting into the hardware wallet space recently with the Jade hardware wallet. So we're continuing to involve that, improving the firmware, improving usability. And so, the differentiator for Jade is that it's full open. Now, some of the other hardware wallets are also open hardware, like OpenSpec. You could, take the blueprints and build one. But the difference with Jade is that it's even more open in the sense that it will work on some IoT devices you can buy on the market today, or from electronic, like Fry's or an electronics store. You can, go pick some parts out of a hopper and pretty much run it or snap a few things together and flash Jade on it, compile your own software, modify your software. Now it won't be as elegant a piece of hardware. It'll maybe be bulkier or have lumps sticking out of it, or, no case or something like that. But it can also be pretty cheap, right? You can buy a lower spec device, without a battery, without a camera, and it will still function, right? Because you can use Jade in different modes. You can use it with Bluetooth. You can use it with USB. You can use it with a camera. And, when it's in Bluetooth mode, you can, of course, if you're using it with USB, you're anyway powered over the USB, so the battery is not necessary. But if you're using it on Bluetooth or with a camera, then a battery is useful, but you can do without the camera, right? So, you can buy one of these ESP32 devices for maybe like $10 or $12 that is able to function with Jade software on USB mode. So that's pretty cool. So it opens the door for emerging market people to do things, and for people who want to try building custom apps to do that, and like maybe send them back to us, and we could add them.
Fantastic. So again, like it's awesome to see all this innovation and the drive to decentralize all this stuff. Democratize is a weird word, but that's what comes to mind. To sort of give the power to people to run their own things and sovereignty that way. So
well, it's an interesting strategy. I guess it comes partly from the open source mindset.
Yeah,
which is a lot of software companies in the kind of feels like TradFi world, like the traditional software world, like the Microsofts, in Oracle. It's all super proprietary, right? It's like secretive, it's closed source. Well, Apple's another good example. It's aggressively licensed. They try to price, they try to like muscle in to the application space and demand payment on the downstream applications in Apple's case. And the open source mentality is more, well, the rising tide, rises all ships kind of thing, that actually the ecosystem would grow faster and everybody would be better if everything is super open, like it's open source, open hardware. You get faster innovation on open networks, you get faster innovation on open source. And, Bitcoin is more an area of friendly competition, right? In the sense that, the people that are competing are not enemies. They're like comrades trying to grow Bitcoin. So I think, and I know there's one specific unique thing about Bitcoin, which is a lot of things kind of have to be open source or you shouldn't really trust them in a don't trust verify sense. Like a closed source hardware or software is something you should worry about because it could have a bug in it or a backdoor and you wouldn't know it.
No, I mean, we 100%, we talk about that all the time, how Bitcoiners are inherently incentivized to help one another because we help ourselves by doing so.
Exactly.
It's just awesome to live that way. Like it's so rewarding. You get to have conversations like these. So, Adam, thank you very much for coming back to the show. Great to see you. And make sure you get a signed, we'll sign you a copy of Clown War.
I hope we can climb back from the precipice. And I think Bitcoin is one of the few kind of technologies and societal forces that is pushing in the right direction at this point.
That is why we wrote the book. It's describing what that process looks like.
So yeah, hope you give it a read and tell us what you think. But yeah, Adam, thank you again for coming on. This has been the Bitcoin Infinity Show, and thank you for listening. And yeah, Adam, thanks again. This has been a great conversation.
Thank you.